we're looking at some of the movers on Wall Street, names that are taking folks' attention today. Diane King Hall, host of Morning Movers here, starting with Applovin, and big news. I mean, they have deal talks, they have the earnings. Tell us about the story.
Yeah, look, Applovin is getting the love today on Wall Street after a blowout first quarter. They crushed expectations. Adjusted EPS coming in at $1.67 a share. That was much better than expected. The street was looking for $1.45, so they beat on the bottom line. More than doubles where they were a year ago. They were just earning 67 cents a share same time a year ago. Revenue surged 40% on a year-over-year basis to nearly $1.5 billion. That's well ahead of what the consensus view was. The street was looking for $1.38 billion. Ad business really fueled this growth. Advertising revenue jumped some 71% year-over-year. They had record margins, 81% margin. That's up from the same time a year ago. So that essentially signals that they have strong operating leverage here. They gave strong guidance for their second quarter. They're projecting that ad revenue will grow 69% year over year, and that adjusted EBITDA will be up 86%. And even the midpoint of their Q2 revenue forecast, that's higher as well. That's top analyst expectation. They're looking for $1.2 billion. They're divesting their apps business. That deal is expected to close this quarter, so that allows them to just focus on their core ad platform. And the stock essentially rebounding now. You're seeing it up 14% now, and that takes it higher for the year, Nicole.
And those short sellers were out there with some allegations. I wonder if there's some short covering happening here today, but certainly a name that is shining. Any final thoughts here on Applovin?
No, you make a good point, because there was a lot of pressure on Applovin because there were all these accusations about some of their ad practices, and they were accused of having unfair ad practices and how that they potentially violated policies within Apple and Google Store, but they've denied those claims. They've called them, quote, factually incorrect and baseless. And despite all the pressure that it had faced even before today, many analysts were actually in the buy camp. So you had a larger majority in the buy camp when it came to Applovin.
Yeah, and they sold off the ads business, and so that is due to close in this quarter.
That's right.
Tapestry, a name that is taken over the S&P 500. It's in the top 10, up 4.4%.
Yeah, I'm actually not surprised to see this, because one of the things that's happened is, Nicole, you and I know this about trends, and I think the trends are playing in the favor of Tapestry, the parent company of Coach. You've seen this shift away from LVMH as consumers try to find the best bang for their buck and still have a nice bag, if you will. So they beat expectations in this most recent quarter. Adjusted EPS of $1.03. That's well above what consensus was. Consensus was 89 cents a share. Revenue $1.58 billion. Street was looking for $1.53 billion. We're seeing shares rally. Coach leading the charge here. It had a 13% jump in sales. They've had a strong run recently. Citi called it continued, quote, very strong performance. They see them having solid momentum into the next quarter. They've boosted their guidance. They now expect a full year revenue of $6.95 billion. That's up from projections of 3 to 4% growth. Full year EPS forecast, they're lifting that to about $5. That's up from their prior guidance. So not only, as we know this cycle, we've seen this theme of just maintaining guidance, and that's the new beat and raise. But this time, this is a true beat and raise like we see with other previous earnings cycles. They're expecting the tariff impact to be minimal. They don't have as much exposure to China. They also did early shipments of goods ahead of the tariff deadlines. We know because of some of the inventories, we saw that many companies did that, Nicole.
And also, as you mentioned, the LVMH, I mean, we've heard from some of the luxury brands a little bit of tepidness. I mean, they were not reporting. I remember looking through some of them. They were not reporting robust sales.
No.
So, sometimes we say like the upper socioeconomic brackets are spending, they don't notice or whatever, but they notice. And so this kind of name is affordable luxury names. You mentioned Coach, Kate Spade's in there. I think Stuart Weitzman. I don't know if they sold that off.
They're selling off that business. business, so they say their guidance obviously doesn't account for that, strips that out. So, that the sale of Stuart Weitzman is not included in that, which they have great shoes. Just a personal opinion. I like their shoes. But anyway, I digress. But again, to your point, Nicole, that you are seeing that, people still want that kind of affordable edge, and they're trying to find affordable luxury. They're trying to find that luxury item. And also, Coach has done a lot with regard to leaning into the influencers and having the it bag right now. So that one of their bags is considered an it bag right now.
Oh, that's interesting. And I will say, in Bloomingdale's, for example, they always put what's hot in this one area, and folks run to that area because they want to be trendy.
Yeah.
And right now, Coach has this particular area. It's a huge spread, and it just sort of screams at you, buy this Coach bag. It's very interesting. They have some great stuff in that. Let's talk about Shopify, a name that's down 5.5%.
Yeah, it's under pressure off the back of its latest results. Mixed results here. You don't want to see that in this current earnings cycle. Adjusted EPS came in at 25 cents a share. Street was looking for 26 cents a share. Revenue came in at $2.36 billion. That was actually on the top line at $2.33 billion, but obviously that doesn't matter in terms of Wall Street's expectations. They're projecting revenue growth to come in the mid-20s. The Street was looking for more than that, so that's also part of the problem. Is not just the trailing quarter, it's guidance, right? It's just not exciting investors. And then you've got the macro headwinds facing. They do have some tariff exposure and trade concerns here for Shopify because they have customers on their platform that are exposed to those de minimis loopholes, right? So because there's now the tariffs that will hit those smaller items, those smaller customers and businesses that use the Shopify platform, that will obviously hit Shopify. And a good portion of their merchants rely on China-sourced goods, so they're exposed to trade policy risk because even with the deal coming today, that's not China.
Yeah, and we talked about some of the other names with the de minimis loophole now being taken away. Those small goods can no longer fly back and forth. And we heard another company yesterday talking about that affecting the bottom line. And we speculated that that could affect Shopify. And so that's something, a gross margin contracting, not a great sign. But it has been over 1 year still up about 15%. A final thought on the day?
Over 1 year it is, but it's certainly had weakness so far this year. If you account for today's move, down about 16% year to date. It's underperforming the S&P 500 when we've seen this kind of broader recovery in the broad market. Shopify not participating in that recovery.
Okay. Diane King Hall, great to see you. Thank you for those three names. We looked at Applovin, Tapestry, and Shopify.